So I think the big theme of what philosophy should investors have is be like water. You've got to be flexible because the world is changing rapidly, and the whole world is doing things that is causing more chaos.
Thank you very much, Mr. Mullins, and thank you for being our shows. And I think we do have a lot of questions to ask you about how to deal with the uncertainties of the environment today. And first of all, could you just please give us a brief ideas about what you have done and your roles and your responsibilities with Schroders?
I'm the head of multi-asset and fixed income at Schroders Australia in the Australian office. So my job is really to look after our investment process for Schroders Australia, make sure our funds are performing well, manage the investment team, our analysts, and really be in control of the strategies we bring to market, the investment process, and the performance of those funds. My main fund responsibility is the Global Target Return Fund that we sell here in Taiwan, but also our Real Return Fund in Australia, which is a very similar multi-asset style process. And the team and I manage around $10 billion at this point in time.
So my second question is about the environment. We all know that our world is changing rapidly, especially this couple of years, and we seem to enter a new normal of high uncertainty. How do you see those kind of external environment change the investment landscape currently?
I think it's a very good question because we try and spend time in our own process to think about not just the current economy, the next Fed meeting, but take a step back and think about structural change happening in the economy. And after COVID, we came up with the view that we've actually gone back to a higher inflation, higher volatility environment. And that's sort of been proven every year since then. My most imminent worry, you're talking about risks, so on the risk side, the worries are right now the Strait of Hormuz closed because of the Iran conflict. That is actually a very large energy shock that the world is currently going through. And if you look at equity prices or the market is expecting us to just get through this and there'll be a deal at some point and the strait will reopen. Now that's probably true, but if it doesn't happen, that's a huge left tail risk. To put in perspective, right now, around 12 million barrels a day is not getting through the Strait of Hormuz. When we had COVID-19 and we closed the entire global economy, there was 10 million barrels a day of demand destruction. So it's a COVID-like shock in the opposite direction. So higher inflation, lower growth, the longer this lasts. So the biggest risk for me is the longer the Strait of Hormuz remains closed, the more damage could be done to the economy. And I guess the other point to the question would be, that's known. Everyone's talking about that right now. The other one that's maybe more left field is we saw overnight OpenAI's revenue disappointment. User also disappointed. If you start to see some of these big AI companies not get the growth they're expecting, then some of the capex assumptions that's leading this current rally in tech stock, but also the economy, might come under question. So again, not our base case, but those are the two big risks for the next, say, 6 months.
Let's take the subject back to Taiwan. And we know that Taiwan's investors do have some preferences, especially on the stock market. Equity is probably the most favored financial instruments for Taiwan investors. And not only, I think currently it's not only in Taiwan stock market, but also in the United States stock market. We are stock market lover. Those kind of, do you think those kind of heavy concentrations in the stock market equities of the Taiwan and United States, it's the right path to deal with those kind of uncertainties ahead, especially the second half of 26?
Well, it's been the right call. It's been a very, very good trade.
For previous couple years.
Correct. So I think the trade itself, I still think is a good trade. There are more risks now than before. If you asked me our views 6 months ago, I would have said, look, US has done very well, tech in Taiwan and other countries have done well, but now other countries are starting to recover, like Europe and Japan, so maybe move away from tech towards a broader exposure in the US and to other countries outside the US. However, since the war in Iran, the energy crisis actually The US is in a pretty good spot, relatively speaking, to the rest of the world, and so are some emerging market countries.
Right.
So for us, we actually like even more now tech. Tech has cheapened compared to the S&P because earnings continue to rise,
Right.
and the price had fallen first with AI worries and then second by the war. So valuations have improved. Taiwanese equities are very expensive, but the growth there seems reasonable. That might see more flows into Taiwan. But similarly, there are still other opportunities out there, like Korea is also a cheap market that has an AI tilt with the memory chips. But your question was about risk.
Yeah.
It is a very concentrated bet. So I'm not saying it's not a good trade, but you might want to think about how to diversify into something that's non-related to that.
Right.
So either diversify away from that one theme or find a hedge that protects you if something goes wrong in that theme. So that's the question. How do you hedge a very good trade? You have to think about diversification. So in the recent environments, if people are worried about a risk-off event, they typically buy bonds. That hasn't worked out so well recently. So commodities was the place to be recently to help protect portfolios.
Right. Traditionally, we used equity bond allocation to diversify the risk. Do you think those kind of strategies still working?
There will be times to hold bonds in your portfolio. The time is when you have a demand shock, or the economy is rolling over, or inflation is falling. But in this higher inflationary world with these demand shocks, it's a very different way of hedging portfolios. And when you have a supply shock, it depends on what type of supply shock you have. If you compare this Iran conflict to the tariff issue we had last year.
Yeah.
So both Donald Trump, both very different outcomes. Equities fell on both of them, but last year, Liberation Day, US dollar fell, euro rallied, yen rallied.
Yeah.
Investors sold US equities, they bought Europe, Japan.
Yes.
Gold did very well, and the yield curve actually steepened. So you had the front end going down, back end staying held.
Yeah.
So if you were trying to hedge Donald Trump's next venture and did those same things, you would have completely lost this time around.
Right.
So this year we've had US dollar rally. We've had gold tank. So for us, hedging is very important. The equity bond correlation is more positive now. So you need to either do one of two things. One is look for more diversification.
Yeah.
Have as many different assets as possible to help diversify you. Not just bonds and equities, but currencies, commodities, credits, alternatives, for example. Or have the flexibility to dial risk up and down when you're seeing potential outcomes coming. And always look forward. What is the hedge you're trying to protect for?
Yeah.
And then adjust your portfolio to accommodate that risk, not the risk from before.
In those kind of environments, do you have developed another kind of a strategy to deal with those kind of risk?
Sure. So multi-asset portfolio, the main idea is trying to deliver diversification to clients, broad universe of investment potential, and deliver smooth returns. I think that's an important point.
Okay.
Because if you're buying equities, you have volatility. When you move to multi-asset, you're expecting to have a smoother return profile, less drawdowns, less volatility. So to do that, you have a broad diversification potential. So you can either be very diversified, using, like I said, equities, commodities, credits, FX, gold, or oil. Commodities is a big thing. You can use alternative assets. You can find uncorrelated strategies. So having a broad breadth of asset classes is very important. But at the same time, if everything's expensive, you sometimes also have to dive deep.
Yeah.
So broad, but also deep. Maybe credit is expensive, but a small section might be attractive. Being able to find those opportunities is very important when it comes to building a multi-asset portfolio. The reason those help clients is because if they do have their tech angle with US equities and Taiwan equities, that helps reduce their volatility and gives them access to other asset classes or other countries that might help give them better diversification benefit. And I think another thing that's really important to focus on is not only do you get that diversification, but the ability to be dynamic and change your view depending on what's coming means you have the right style of protection in the portfolio. So I would say it's hard to do it yourself.
Yeah.
So a multi-asset product does give investors that solution that they don't have to think about it themselves. So it's a nice core in an otherwise bigger portfolio or even a defensive asset, depending on your risk tolerance. You focus on what you want to do in your tech stocks, have a multi-asset portfolio run by a professional for you. But of course, you have to have an investment process to be able to do that. So for us, I mean, it's such a wide variety of options to invest in. You need a way to sort of funnel that down and figure out what the opportunities are. So for us, one of the processes we like to look at is what I call the VCL process, or value, cycle, and liquidity. Valuation is a starting point. You can see where opportunities are, but also where risks lie. And it also gives you relative value opportunities. So maybe everything's expensive in that asset class, but certain countries or sectors look relatively better. But valuation is a terrible timing tool. So you start with valuations. Then you have to look at the business cycle. Business cycle tells you two things. One, how much risk to take, but also where to take that risk. So obviously, if you're heading into a recession, de-risk. If you're heading into a recovery, have more risk. But in a recovery phase, you want to have more high yield and small caps. In a slowdown phase, you want to have more growth companies or quality companies. So understanding where you are in the cycle for every country is very important. And the final L, liquidity, is a way to make it about here and now today. What is market sentiment? What is market positioning? Is it stretched? What is the central bank doing? What is fiscal policy doing? This gives you more opportunity to say, now today is the time to invest. So bringing that together, you have value, cycle, liquidity, long-term, medium-term, short-term, gives an idea how to move the portfolio around and find those opportunities that we mentioned. But also, if you're an investor who believes we are in this regime, there is volatility, there is uncertainty, you can profit from that in a multi-asset. So being dynamic, being agile, looking forward means not only protecting risk, but you're finding opportunities. For example, right now we don't like Europe because we're worried about the energy shortage that could be occurring there. So we dive deeper and go, well, within Europe, Germany is the main country that has energy issues, and they're a large manufacturer that can sell stuff offshore. But Spain and Italy, they have domestic growth that is strong. They have good GDP growth, they have good earnings growth, and a cheap market relative to Germany. So again, diving deeper, we find opportunities for return, but at the same time hedging risk by being underweight Europe. So long story short, those who want to take de-risk their portfolio, multi-asset works very well. Or those who want to profit from this new regime of volatility, multi-asset is a very good product for them.
Given the challenging market backdrop, and I know that Schroeder's you just introduced a new strategy which is called Global Target Return, which is particularly implements those kind of ideas into your strategy. Could you just share with your ideas about what is the Global Target Return strategy?
Sure. So the Global Target Return strategy is a multi-asset strategy that's aiming to deliver US dollar cash plus 5% over time. So giving investors positive returns, good quality returns. But more importantly, specific to our fund, is we say with lower volatility and lower drawdown. So for us, the path of returns really matters. We want to make sure you don't lose lots of money when an event occurs. So that's something we spend a lot of time focusing on. So not only do you deliver that smooth returns, the way we do that is we actually do offer genuine diversification. So I mentioned earlier about finding those opportunities by diving deep. We have allocations in, for example, Latin American equities. That did very well with the oil shock right now. But also finding other diversifying assets that other investors might not get exposure to. So it's not just equities and bonds. We did have a lot of gold in the portfolio at the start of the year. That did really well. We took profit in January. We sold all our gold in January and moved to broad commodities. So when we had the current crisis, broad commodities did very well, gold fell. We could then rotate away from commodities back into gold. So again, having that flexibility was very important to us. But we also find asset classes like insurance-linked securities. I don't know if you've heard of that, but it's quite a niche asset class. It's a very high-yielding bond. It yields around 13% in US dollar terms. But you lose money if a hurricane hits Florida. So it sounds risky, and it is, but first the insurer gets written off, then the reinsurer, then finally you get hit. But weather doesn't care about the economic cycle. It doesn't care who the next Fed chair is going to be. So it is a pure diversifier. So having exposure to those kind of assets is very important. So having the breadth of opportunity, having that active management that I mentioned, dialing risk up and down, finding the hedges that will work in the future is very important. And finally, we are an active house. So we deliver in this portfolio top-down active asset allocation decisions. But when we go and allocate, we have bottom-up stock pickers and bond pickers choosing the best companies. So we have teams around the world. I think we have 650 portfolio managers and analysts around the world. They then pick the best companies to put in that. So it's the best of our top-down and their bottom-up experience.
Seems a pretty ideal strategy, but my question is, how did you manage the risk? And at the same time, you also capture the opportunity. How did you manage those kind of portfolio? How did you strike a balance between the two? Could you just share with your experience on managing those kind of asset class?
Sure, well, it's part of our DNA. That's what we do. You asked before, is it hard? Yes, but that's our speciality. It's what we do. Another thing we do differently is, it might sound strange, but we say risk is not volatility. So risk is losing money or not achieving your targets. So we actually don't look at volatility in markets. We look at what we call the probability of loss.
Wow.
And that's different because it actually makes us a bit more contrarian in nature. So you look at volatility, think about all these bad events we mentioned. Volatility spikes. The probability of loss actually falls during those periods. And then when volatility is very subdued and markets are complacent, our probability of loss actually rises, saying it's starting to get risky now. So we typically get out of risk early, then an event occurs, then we buy the low, but then we have the safe part of the rally, and then we get out a bit too early. So because we have lower drawdowns, we can pick up faster on the way out because we don't have a big hole to go down in.
What kind of risks did you foresee currently, and how did you help the investor to prevent those kind of risk or volatilities, and what kind of mindset an investor should have to deal with those kind of uncertainty in the second half of 26?
So I think the big theme of what philosophy should investors have is be like water. You got to be flexible.
Well, it got to be flexible.
You got to be flexible because the world is changing rapidly, and the whole world is doing things that is causing more chaos. So you have to be adaptable and move the portfolio around to accommodate that, not just to make money, but also, as you said earlier, to find those hedges. Looking forward right now, in my mind, I have a checklist of things I wanted to buy during the Iran crisis. Now again, the Iran crisis isn't over. We want to see the Strait of Hormuz open. So we did raise cash, as well as those other hedges I mentioned. So we had a checklist of what's the first things we want to buy in order. The first was buy some bonds when all those rate cuts get priced out. So the US had 3 rate cuts priced for this year. Now there's none. But at one point last month, they had about one hike, half a hike priced. We started buying some duration. Credit spreads then blew out a lot. US high yield credit default swaps blew out 400 basis points. So for us, that was an attractive way to buy. So we started buying some credit. So the longer it took for this to last, at least we get some income. Then buying equities was the last one. But we started buying US equities, US tech. So right now, I'm sitting on cash, waiting for the Strait of Hormuz to reopen. If it reopens soon, I'll be buying back Europe and Japan and some other emerging markets. But until I see that Strait open, I'm concerned about the energy crisis that might be coming for some of those other countries that are not the US or China, because they're relatively insulated compared to, as I mentioned, Europe or Japan. So be flexible, watch what's happening, have a process that helps you limit the drawdowns and limit downside risk, but still allows you to capture the upside with minimal downside.
My last questions. We need your suggestions, your advice to the investor in Taiwan. Is how should we foresee the coming risk or coming uncertainties, and how should we prepare for the volatility ahead?
So I think the main thing to look at for the investors in tech in Taiwan specifically is the AI spend. So we've seen that OpenAI news overnight about the missed expectations. If we start to see that occur in more AI providers or even the Mag 7, that could stop some of that CapEx coming through, and that will affect Taiwan equities specifically. So again, not my base case, but start to see some of those stories come through. It might be worth starting to de-risk a little bit and allocate to a multi-asset portfolio, for example. Right. In terms of how multi-asset portfolio can help you with that, I think having that flexibility is a really good place to be. But for now, it's more about finding where you can start to de-risk on the margin, because it has been a very good run. It might continue to be a very good run, but there's always opportunities elsewhere that investors could be missing if they're focusing just on that one trade.
相信大家听了施罗的基金经理的分享之后，一定知道26年还有非常不确定的因素在等着大家。那大家一定要保持弹性。谢谢大家今天的收看，我们下次再见。
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。